Hello and welcome to episode 424 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, welcome back. We're here again.
We are here again, and we say we're here again. I'm soon not going to be here. We're going to take a break next week, so I'll get that out of the way up front. There will be a break from the podcast next week, so don't go anywhere. We'll be back the week after. Andy and I are going to be having a break, not together, mind you, even though people do probably think we are like Bert and Ernie and we do everything together. We are spending time with our respective families. We're going to have a week off, and then we're back with a vengeance the week after next, so make sure that you come back and listen to the podcast. But with that out of the way, I am quite excited to have a mini break. It's been quite a long first half of the year with lots going on, and in the summers where the money world starts to take its foot off the gas a little bit. So yeah, we're going to have a bit of a break, but in the meantime, make sure that you send in lots of reviews. That will make us very happy when we come back. And as Andy mentioned on last week's show, we've got a load of Money to Masses mugs that are looking for homes. So if you give us a review, 5-star will be the thing that will probably clinch it for you, then you could be getting a Money to the Masses mug.
Yeah, I mean, some people would call that bribery. We call it encouragement, and it'll be lovely to hear you getting in touch. And like Damien says, it really does help to keep us fully motivated and happy to provide more free content. Right, so let's get on with what's coming up on this week's show. What have we got coming?
So the first piece is an update really to an investment piece I did 5 years ago. In that podcast, I talked about the stock market indices that I track, and some of them are bond markets, a whole host of them that I track on my phone that I look at each morning when I open my phone, and I can look at them and the interactions between them and get a quick idea of what's going on in markets, what might be driving markets, and therefore what kind of headlines to look out for. And I'm going to give you a live example. So I'm going to provide an update to that. The next piece is about financial decision making. So we all encounter various situations in life. It could be relating to investing, it could be relating to your mortgage, and you need to make a decision. And it is useful to have a framework which to use to try and make an informed decision, because there are processes you can use to try and get a more balanced decision. So it will help you overcome some of your own biases. And the last piece I want to talk about is something called the halo effect.
Okay, so let's get on with that first piece then, Damien, and you're going to provide some insights into exactly what you do to keep abreast of investment markets.
Yeah, so I mentioned in a previous show that when I wake up in the morning, I often open up certain things on my phone to keep abreast of my personal finances. So it might be a budgeting app, for example, and I might look at the app and the statements on my account. Just to give a quick overview, I'm just looking, spinning the plates, making sure things are ticking along as they should be. And the other thing I do is I open up the stock market app on my phone. Now, I'm not obsessed about looking at my own investment portfolio. In fact, I never look at my own investment portfolio, the value of that on a given day. I tend to review that maybe once a month, just have a look what's going on with it, but nothing really more than that. And I then might make a decision subsequently. With 80/20 Investor, obviously I run a portfolio that started off with £50,000 in it that I have grown over time. Actually, it's got a profit of about 50%. I've been doing that for 8 years now. And of course, people who are subscribers to 80/20 Investor know that I then review my portfolio, might make some changes. But on a day-to-day basis, I like to get a feel for what's going on in investment markets. And you can do that very quickly, because if you set up your stock market app on your phone, now whatever phone you use, there will be a default app, but you can find others. So there is an app called investing.com. So investing.com is a website. They have an app which is very good actually. It's free. You can download it, and then you can put various different indices on there. For example, the FTSE 100. That's one just off the top of my head that you could put in there, and then you can see how it's moving live. And what I find useful is to set this up with certain exchanges on there, certain stock markets, and by looking at it, I can get a feel for what's going on, potentially what's driving markets right now at that point. And then I can think there's something's happened, and I can guess probably what it is, and I can go and look at the news headlines and find out what it is that's driving markets. And it's particularly relevant if you see some really big market swings. So we're not obsessing about what's going on with markets. What we're doing is learning what's driving markets and understanding them, and therefore you can understand what's driving your portfolio. And even if you're a passive investor, I believe this is a good exercise, because what it means is you tend to stay the course. You don't become emotional. You start to understand what is going on, that the movements you see are a natural cycle. They are responding to news flow. Some of it will be very knee-jerk, and it might move back the other way the next day. So what I'm going to do on this piece is go through what I look at very quickly. Now, podcast episode 184 was recorded 5 years ago, and we do make our content evergreen on this show. So go back and listen to that particular episode, because that was the first episode where I covered the markets that I have in my app. And I'm going to run through some of those again and tell you what they are. But if you go back and listen, it's well worth it, because you'll get an explanation as to why they're in there. But also you'll get a reference point to a point in time, which was 5 years ago, how I was looking at them, how they were interacting and what it told me. And I'll give you just one example. Back then, we were all obsessed with the US-China trade war. It's less of an issue at the moment. So markets were moving, and I could look at certain indices and see that I bet there's been a new headline that's come out. And at that point, it was from Donald Trump, who was the president of the United States. Probably had a soundbite that caused a bit of market movement. Now I'm updating this list, giving you a few more, but they will tell us about some of the big macro stories that are going on in the background. So I'm going to get my phone out. If you're watching this on YouTube, you'll probably see me looking at my phone. I hope this is not going to impact the recording in any way. So the first one I look at is the US dollar index. Now, if you go on your app, it will usually have a ticker of DXY, maybe have T.NB after it, but you can search for the dollar index, and that is a measure of the strength of the US dollar against a basket of currencies out there, including the pound and the euro. Now, I didn't used to track this 5 years ago, but if you get the dollar right, then you tend to get most other things in investment markets. So if you get the direction of where it's going to go and you somehow front run that, or you happen to be riding that wave up or down, then it has such an impact on other markets, then you'll probably get the other things right along the same time. So to give you an example of that, when the dollar index rises, that means the dollar's strengthening. That tends to be bad for things like commodities. And sometimes the dollar can go up and down because of headlines that are occurring out there that might be in relation to other central banks. At the moment, the biggest thing that is driving markets is about inflation in domestic economies and what central banks are doing. And we've seen in recent months the US Federal Reserve seemingly more dovish than some of the other major central banks, particularly the Bank of England. And of course, what happens when market expectations change, then that can influence the currency exchange rate. So if the US Federal Reserve is expected to perhaps pause its rate hikes versus the more continued rate hike cycle that we're seeing in the UK, then the dollar will weaken against the pound. And of course, the dollar will likely weaken against the euro as well, because at the moment, the European Central Bank looks to be still in its rate hiking cycle. And what that will mean is the US dollar index will fall. And of course, that will have implications for other markets, like I said, commodities. It will likely mean that emerging markets will do well. It will likely mean that the S&P 500, the US stock market, will do well. When the dollar weakens, it tends to be a tailwind. So I look at that. I look at what's going on with the dollar index, because if that was suddenly up as well, it can be a sign of panic, because people do tend to move into the dollar as a haven asset. I mean, often the yen works in the same way like that, but historically the dollar has been a haven asset. So I look at the US dollar index. I like to see if there's any big moves, that means something's happened. At the moment, it's probably something to do with central bank policy or inflation somewhere, or it could be there's been something a bit bigger than that. Perhaps there's been some geopolitical concerns. I then still have the US dollar and pound exchange rate. You can search for that. It's GBP USD equals X. That's what it's typically on the stock market apps. I have the pound euro exchange rate, and I also have the pound yen exchange rate. So again, the dynamic between each of those currencies will tell you a lot at the moment, probably about the outlook for the central bank monetary policy in those particular economies. So if the pound strengthens against all of those or any of those currencies, then it probably means that the market is viewing that the Bank of England is going to be more hawkish, meaning probably more rate hikes. Or it could be that one particular bank out there, central bank I'm talking about, maybe it's the ECB, ECB is being more dovish, talking about potentially pausing, then you might just see that pound euro exchange rate change and the others stay constant. If that was to occur, you would see one move and one not. You know that there's something probably going on in the news relating to that particular central bank. I still have the VIX, so VIX, that's like the market fear gauge. Historically, that number's around sort of 1921, but at the moment we're below that. So I look at that. If there's a big spike in the VIX, that means the fear's gone up in the US stock market. The VIX is a volatility measure, but effectively just think of it as a fear number. So if that goes up very quickly, that means the market's got spooked. I now also look at the NASDAQ 100 VIX. It's got a ticker number of VXN. So find that one. That's the same thing as the VIX, which is relating to the S&P 500. This is relating to the fear on the NASDAQ 100, which is much more tech focused. I'm still looking at the 10-year US Treasury yield. That has a ticker of TNX. Now, a couple of years ago, well, back when I did this last, I said a couple of years ago, 5 years ago, the yield on the 10-year was 2.8. We're now obviously much higher. We broke above 4 recently. When that yield goes up, that means that the value of the Treasury is going down. So the 10-year US Treasury. In recent history, that has been going up because of inflation concerns. So when I open my app in the morning, I look at the yields on that particular issue of the US Treasury, but I also look at the 10-year UK gilt yield. So the stock app on the iPhone doesn't have that as a standard because Yahoo doesn't really have that ticker, but you can find it on investing.com's app. So get the 10-year UK gilt yield on there. I mean, as a UK consumer, it also shows you that yields are going up. If you follow that and it's going up, then in time it will probably start to have an impact on mortgages as well. So I do like to track the yields on those because they also give you a feel for bond markets more widely. So if yields are going up, then that's going to be bad news for bonds, but it also probably means that there's been something going on in the news that is suggesting that maybe inflation is going up, or that the UK economy, or whichever economy, it could be the US if we're looking at the US Treasury yield, it could be that if the yield is going up, there's been news about how robust that particular economy is. Or if the yield suddenly tumbles, it could be because there's fear out there of a recession. So you might see there's some headlines out there. Maybe a central bank has talked about recession. I still track the FTSE 100, the FTSE All Share, and the FTSE 250. Now, the FTSE 250 is very domestic orientated versus the FTSE 100, which obviously around about 80% of the constituents of the FTSE 100. Those companies get most of their earnings from overseas, particularly denominated in US dollars. So what you tend to see is that if the pound strengthens against the dollar, going back to that early exchange rate that I track, then it tends to be bad news for the FTSE 100. So sometimes you'd like to see that when that goes up, that's the pound versus the dollar, then maybe the FTSE 100 will go down. If that doesn't happen, you start to ask why. It would be slightly unusual. So you might look at other things that are going on out there. You might start to wonder what news is driving that sort of divergence from historical norms. But of course, if the pound falls against the dollar, then the FTSE 100 will, of course, go up. Not guaranteed, often does. I like the FTSE 250 because if there's been a rally in that means there's been some good news probably about the UK economy. Of course, I'm still tracking the S&P 500, the Dow Jones, and the NASDAQ in America. Now, those three, they are obviously key to a lot of markets out there. What goes on in America tends to influence a lot of other markets. And because of the time difference, in the morning when I wake up and I look, I will see how markets finished in the US, and it'll probably give you an indication of what could happen in the UK and in Europe once the markets open. And of course, we have Asian markets, which I'll come on to shortly, that I look at as well. But I'm really interested in the difference between the S&P 500, the Dow Jones, and the NASDAQ, because they don't all move up in tandem. It's when you get a divergence that I'm interested. The S&P 500 is influenced heavily by those big tech names, and they have driven most of the rally in this year. When you see the Dow Jones maybe go down, or the NASDAQ go up when the Dow Jones goes down, then it's that interaction that I'm intrigued at. So often you might see the S&P 500 has gone up. All three of them, actually, you often see go up, but you might occasionally, I should say, see the S&P 500 go up, the Dow Jones go down, and the NASDAQ go up, or the reverse pattern. That tends to tell you there's something that is going on underneath. So it's to do with particular sectors, because the Dow Jones, again, is more economically focused. Because it's a smaller index with fewer companies in it, The German DAX I'm still tracking, so that ticker is GDAXI, and of course the Euro Stoxx 50. Now, the reason that I like the DAX is because it gives you an indication of European stocks, but it also normally has a high correlation with S&P 500. So if it's not moving in the same way as the S&P 500, so they kind of move in opposite direction, that probably gives you a hint there's a European story in there. And of course, a lot of this 5 years ago would have been related to the fallout of Brexit. We don't have that as much now. But what you might see now, when I see the DAX do something, and it might be, let's say it was negative, or it might have been very positive, I then go and look at another index that I track, which is the CSI 100 index, which is a tracker of the Chinese stock market. I look to see if that's up big, if the German DAX has gone up, because it could be a growth story, a Chinese economic growth story. So at the moment, we're getting concerns about the strength of the Chinese economic recovery since the pandemic. If we get a headline that's negative around that, look at the Shanghai Composite in the morning. If that's down significantly, and then look if the DAX is down too, then that has a high exposure to the Chinese economy because of the export. Germany is a big exporter to China. So the German DAX will be impacted more so than maybe some other European stock markets. So I'll look at the Euro Stoxx 50 for a general European outlook or what's going on with European stocks. But I then look at the German DAX, and if something is happening in that index, I'm thinking perhaps there's something going on in China, and I look for that particular headline. Moving on, I'm not going to go through all of them because I'll be here all day, but some others that I look at is the price of gold. So that ticker is GC equals F. I look at copper, HG equals F, and I look at crude oil, which is CL equals F. The reason I like those is because gold can give you a hint. If there's panic, then the gold price might go up. If there's not fear, then it might go down. But also gold will move significantly when there's rate hike expectation changes. So let's say, for example, the market suddenly thinks that inflation was stickier in the US than previously thought, and that the Fed would have to hike rates. What you'll probably see is gold will fall, because gold tends to do poorly in an environment where rates are going up. I like to look at copper and oil because they're commodities. So if they are up big when I look at them in the morning, then again, if I look at what's going on with the Chinese stock market, it probably means if that's up as well, there's been a headline about economic growth in China. Some data has been released. I also look at Asian indices, the Nikkei 225, which is the Japanese stock market as well, because again, that's still a significant stock market, but I don't dwell on it too much. The other things I like to look at is sector-based stuff in the US. So I look at the utility sector, which is XLU, technology sector, XLK, financial sector, which is XLF, and I also look at the healthcare sector, which is XLV. These are all the tickers you put in. They're actually ETFs that follow these particular sectors. And there is an energy one, which is XLE. Now, I like to look at all of those because if they move in different directions, which they do tend to, you do get days, of course, where they all are up or they're all down because the market is generally being either risk on or risk off. Then that in itself is quite interesting, because if they're all up, then you know that the market was in a state of euphoria about something, and it's something that's generally very positive. So they'd all be up. But if it's something just generally negative, they'll all be down. But if there's a differential between them, let's say, for example, utilities and healthcare are up, but some of the other sectors are down, they're more defensive sectors. It could tell you there's something going on, that maybe there is a concern about recession. Normally, if the financial sector's up big and the technology sector's down, then I look at that and go, there's been a story again about rate rises, because when rates go up, so interest rates go up, the finance sector tends to do better. We talked about this, I think, recently on the podcast, about when rates go up, banks make greater profits. That's the general rule of thumb. But technology stocks tend to underperform, because when rates are going up, because their earnings and a lot of their profits might be way off in the future, when you discount that back with a higher interest rate, it will mean that that number is smaller. So just think of share prices as being a discounted number, a discounted value of future earnings. Therefore, if that interest rate is higher, it means that the share price tends to be lower. You don't need to really understand that, but just believe me, technology stocks don't tend to do very well when expectations of rates going up are occurring. And a part of that is also maybe because it could be that some of these smaller technology companies, not the massive ones, but some of the smaller ones might have high levels of debt which they have to service. So there are others I look at in terms of individual stocks. I do look at Amazon, I do look at Apple, I do look at Microsoft. And the other one I talked about in the last show was Boeing. Boeing can be a good economic indicator, because obviously if the economy is doing well, then Boeing tends to do well. They'll be manufacturing planes. I think Apple is one that's just a broader indicator for the market. I mentioned it on the last podcast. Well, I say the last one, I'm talking about the episode 5 years ago. As goes Apple, so goes the market, is the adage. Now, that doesn't always hold true, but if Apple's going up big, it tends to mean the market does, or vice versa. So I tend to look at those to get an indication. Is there anything going on at a company level? And I do like looking at Microsoft at the moment because that is a big tech play. And when I say tech play, I'm really talking about AI, because AI is one of the things that's been driving markets. And there's a bit of euphoria about AI, artificial intelligence at the moment. So I look at that particular stock price, and I think that gives you a good sense of if any moves are being driven by AI enthusiasm. And Nvidia is another one. So there's just a bunch. I haven't covered everything, but I've covered a hell of a lot. But what I want to do before we move on to the next part of the podcast, Andy, I'm looking at my phone, and like I say, if you watch this on YouTube, you can see I'm doing this live. And what I'm looking at is a live look at the market right now. So what I'm going to tell you is that as I'm looking at this, and I'm not going to tell you what the news story is until the end. So the dollar index is up. We've just got towards that 100 point, that 100 number, which is quite key. But the pound versus the dollar is down 1.2%. It was above $1.30 yesterday. It's now down to 1.288. It's a big move. Yet it's also down significantly against the euro and the Japanese yen. So it wasn't just one currency that it's fallen against. It wasn't just the dollar. The pound seems to have fallen against all currencies. So I'm looking at that now going, right, there seems to be a story out there that's relating to the UK because it's weakened the pound against a number of currencies. So it's not just one-on-one. It's not just something to do between, say, the UK and Europe. So what I then do is I'm going to look down at the bond yields. They're next on my list. The US 10-year Treasury is pretty flat, not doing anything. But when I look at the 10-year UK gilt yield, that's down by 2%. So in terms of basis points, it's actually down about 7 to 8. That's quite a big move. We've just been seeing the UK gilt yield going higher and higher of late. I now look at the FTSE 100 and I'm like, hold on a second, that is up 1.9%. So as I mentioned earlier, the pound is weaker against the dollar significantly. You'd expect a boost to the FTSE 100. We got that. But look at the FTSE 250. You can't see this, but I'm just telling you, it's up 3.6% so far today. That is mental. That is a huge number. So my sort of spidey senses are going off. That is a big number for the FTSE 250 for any index. There is something that's been announced or headline that's going to have a big impact on the UK domestic economy because of the size of that growth, that rally versus the FTSE 100. So I'm looking at that and thinking, well, it looks like it's going to be a UK-based story. I look at what the S&P 500 are doing and the NASDAQ. They're all basically up about the same amount, about 0.2%, nothing much. I look at the German DAX, is actually up 0.02%. It's basically flat. And the Euro Stoxx 500 is down ever so slightly. I look at the Chinese stock market, it's down 0.4%. Nothing really exciting going on there. And I look at gold, it's down about 0.3%. And so what I can see from this when I'm looking, there is a UK-centric story clearly. And the giveaways are the pound has fallen significantly against the dollar and against other currencies. The yield on the 10-year gilt has fallen considerably, and we've had a rocket go under the FTSE 250. So straight away, without me even having to look at the news, I know that the good chance of what's come out is either the Bank of England has done something like said it's going to pause rate hikes, or it's not going to cut them at the moment, but it could be a possibility in the future, or inflation expectations have dropped. And lo and behold, if you go and look at the news story today, what was the biggest story this week? It's the fact that UK inflation came in under expectations. So it was lower than people expected. And that's impacted all those markets in that way. And it's particularly the UK. So you can see by looking at these, I was already able to see what's going on here. Whereas if I just looked at my portfolio day to day, or I'd be sitting there thinking that something was happening that was particular to my portfolio or the funds that I'm in. But what it really does by doing this is just to get you a feel about how assets behave with each other, what markets do, how you can build portfolios, diversification. It teaches all of these things. And it goes back to a point I raised in that original podcast when I did this the first time round, is that this sparks an interest, because when you see something move and you can't explain it, you should think, why is that not doing what I thought it would do? Or like I said about the pound falling against the dollar, I then looked at the FTSE and expect it to be up big. And it was. So that's like, yeah, I'm understanding that dynamic there. And the FTSE 250, that's up big. That should say something about the UK domestic economy. Yields are down on the 10-year UK gilt yield. Well, why is that? Yeah, it could be a sign of potentially people thought there could be a demand for gilts because we could be heading towards a recession maybe, but that doesn't make sense because the FTSE 250 is up. Well, that tells you that people think the profits of those companies are going to go up. So that tells you that it's not the recession that people are worried about. It's actually rate expectations. So I enjoy doing this. And if I can try and spark some interest in other people by looking at these stories and looking out there and trying to work out and piece the bits together and then suddenly go, yeah, there was a story. That was it. I think that's a little bit of magic that makes people then start getting into investing.
Okay, so let's move on then. The next piece, Damien, it's about decision making. What have we got?
So this piece is about how to make better money decisions. Now, go back to podcast 246 because it was a topic I looked at back then about making better money decisions. And that was recorded in November 2019. And I don't know if it's sad to say that I went back and listened to that show and I really enjoyed it, given that it was me and you talking. But there was an insight that I gave in that particular show about how you shouldn't solely focus on the outcome of a decision that you make to assess whether it's a good decision or not, whether it's the right one or not. And listen to that episode because I explain that in more detail. What you need to do is really have a process and you look at that process that helps you make decisions and see whether that's the right process, because you can have the right process and make a decision in the right way, but the outcome cannot be what you want, and that can be just down to bad luck. And I explained that back in that particular episode. So it's a very good episode. But one thing I wanted to do is I didn't really talk about ways of making decisions. I talked about it in relation to investing. Of course, I have something called 80/20 Investor that people can subscribe to, and that has a process in it. But I wanted to think about the wider money decisions that we have out there. And this is an example of a process that you can use to hopefully I should say, help you to make a decision, an informed one. And the problem we have is that you'll have points in your life where you've got to make a decision. They happen all the time. And some people would wish that they could have, like, they just know what the answer is. Can you just tell me what I should do? And the reality is that all that happens if somebody asks me that about their own finances, or I'm looking at it for my own finances, like looking at making a decision, let's say about whether I fix my mortgage or how long for, in my head, I'm following a process. And I was sitting there trying to work out, well, what is that process? Because if I can teach somebody else, then it's that whole thing of if you can teach a man to fish. And I sit there and think, well, if we can do that, where we can teach people to fish, then that is better than just trying to tell them the answer. So I was mulling over how we do this, and then it got me thinking about the 6 thinking hats. Now, this is a very simple tool, but it's a powerful tool that was created by somebody called Edward de Bono, and it's based on the principle of parallel thinking, which is where everyone thinks in the same direction from the same perspective at the same time. And so that could mean that you have a bunch of people in a room and you get them to think about a problem in the same way for a period of time, but you can then change the way that they're thinking to try and come up with creative solutions to problems. Some people listening to this podcast may have come across this idea, but I know there will be plenty that haven't. So what I want to do is quickly explain what the 6 thinking hats are. It's an interesting idea, and then I want to explain how you could perhaps apply it to your own finances. So the way the 6 hats work, there are 6 colours, and they are given certain roles, and some of them are opposite. So if I run through what the colours are, I'll put a link in the notes of this video which will take you to a reference about this technique, but it's very well known. So there are 6 hats. So there's a white hat, there's a black hat, a green, a blue, a yellow, and a red. And the idea is that if you wear these hats, or while you're wearing these hats, and obviously it doesn't have to be real, we can just talk metaphorically, you think in a set way. So if you're wearing the white hat, you're thinking about information, data needs. So if you've got a problem you're trying to solve, it could be at work, it could be in your finances, then what you do is that you make yourself think with the white hat about all the information that you need. So you go out there and you data gather. When you wear the black hat, this is all about negatives and risks. So you sit there and you brainstorm the risks, the downsides about the situation. When you wear the green hat, you are creative thinking about ideas, alternative solutions, and you're being a much more free thinking. When you wear the yellow hat, you're thinking about the benefits and the positives of the scenario. So you might be thinking, if it's to do with a particular, say you're launching a company, you're thinking about all the positives that could happen. What are the things that could work in your favor? But then you go on and you look at the red hat, and the red hat is talking about emotion, gut feeling. So you're sitting there thinking about, how do things make you feel? What do you feel about a particular scenario? Would it keep you up at night? If it's about business, it could be, well, what is your instinct telling you about where that particular market might be going if you're going to create a product for it, for example? And then there's a blue hat, which is you manage the whole thinking process. You pull together really what's been going on when you're wearing all the different hats. So you can sit there and think, right, I'm going to use this process to solve or come up with a decision for a problem that I'm facing in my personal finances. And if you are doing this with multiple people, you could be doing it with a partner. The idea is that you would sit there and you go, right, we're going to wear each of these hats in turn for the same amount of time, which you limit, because otherwise you will just get bogged down, let's say, in the emotional side of things, which is the red hat. So you give yourself a time limit and you both sit down and think about, for example, the pros of a particular situation. So that's the yellow hat. The benefits. You might then move on to being the black hat and use the negatives and the risks. And so what you're doing is you're going to go through all of this process, parallel thinking, all doing the same thing at the same time. If you're on your own, it's a little bit easier. But why I like this process is that it makes you think differently, because there is a tendency, I believe, that we all gravitate to one or two of these hats. We have a natural inclination. So I'll give you, for example, I'm definitely a black hat thinker. So I will focus on risk rather than being somebody who is just obsessed with the benefits and the positives, like the optimist, which is the yellow hat. So there are ways of doing this role. It's sometimes suggested that you might, for example, do the green hat first, which is about the idea generation and the other potential solutions that are out there. And then you might move on to the yellow hat when you're looking at the pros, the benefits, the positives, then the black hat, which is the negatives and the risks. Then you move on to the white hat where you gather information or the data that you need. And then you might go on to the red hat, which is about the emotional side and what you feel. So it's a thought process that has worked for lots of different scenarios. And going back to that old podcast, you've got to have a process that you use, whatever your process is. If you don't have one, then this could be a process you might find useful. You could adapt. But if you have that process, then when you get an outcome, you know that the process you used to get there was valid. And therefore, whatever outcome you get is either down to good planning, good thought process, or bad luck. So I'm going to give you an example how this could potentially work. So let's say you are thinking about your mortgage. So you are deciding about what to do with your mortgage right now, which is what lots of people are doing. Seems to me that's all people are thinking about when I go somewhere. They just want to talk about mortgages. So you might sit there and look at, right, what are the options? So you might start thinking about whether you're going to fix your mortgage, how long for, whether you go for 2 years or for 5 years. And so I'm going to just go through the hats. It doesn't matter the order, but I'm just going to go through the white hat first. So you might go out there and gather all the information that you need. So you might sit there and go and gather the rates that you could get. What are the best rates out there? What's the rates that you could potentially get based upon your loan to value and your earnings? So you're going to go and data gather, use some of the tools that we might have on our website. You might look at what the market predictions are for where the Bank of England base rate might go. You might gather information about what your earnings might be in the future. You might gather information about what your plans are in the future, what sort of flexibility that you might need. So there's a whole host of information that you will need from that. So you might have that information. Let's say you decide to do the green hat. Like I said, you don't have to do them in any particular order. And you've come up with the idea that you might fix your mortgage, but you can think creatively. Do I need to fix my mortgage? Is it that I can only fix for 2 years or 5 years? Is it possible to fix for 3 years? Is it possible to have a combination of mortgage products? So I have part tracker, part fixed mortgage. Can I do a 3-year fix and a 5-year fix? This is where you're thinking creatively and not being constrained by your thinking at present. So by doing that, that then starts to give you some questions that you might want to go and answer. And this is one of the reasons why often people do the green hat first, because you might come up with lots of solutions and somewhere down the line, you need to do the white hat to find out the information of, can I do that? Can I do a combination of an interest only and a fixed rate mortgage? The answer is you can, but you would go and find that information. So you could do the green hat first and you come up with those creative solutions. Then you go down and you might use the yellow hat, for example, and you look at the benefits and the positives. What could happen? Being an optimist, rates could come down. So if we don't fix, rates might come down and we might be better off. What's the positives in terms of the products that you can get? What rates could you get? You then move on to the black. What are the risks? Well, the risk could be that you might lose your job. What's the risk that rates keep going up if you have a tracker? So you get all of the pros and cons and you look at all of that, and then you look at the red one. And the reason I use the mortgage angle on this is because I do think the red hat is sometimes overlooked. Often in investing, the red hat gets too much exposure. People focus too much, which is why it's good to limit the amount of red hat thinking that you do. But when we're talking about this, for example, in a mortgage, if you are going to be kept up at night, worried about at some point rates will keep going up and then you won't be able to afford your mortgage and you might lose your house, if that emotional, how that feels being on a tracker, if you acknowledge that, that can feed into the decision-making process. It doesn't have to be the sole driver because it's one of the 6 hats. So you can put that into it. And then you have the blue hat that pulls this together, manages the process. Then you can start going back round again. So you can start looking, make decisions, refine things, and then you can come up with a solution. So that's why people can do this process and come up with different solutions. They could fix for 5 years, for example, because they've looked at all the different angles. And for them, partly it might be the red hat that's had an influence, that they are more worried about the security of keeping their home and being able to afford their mortgage, rather than being somebody who's been an optimist thinking that rates are going to come down and they'll be able to get a cheaper mortgage. So use this style of thinking. It can be useful, adapt it. But I just wanted to throw a process out there for people, because sometimes people do ask what's the best thing to do. And the answer is there is never an optimum decision. If you look with the benefit of hindsight, of course, you'll know what you probably should have done, what would be the best thing. But going back to podcast 246, you make better decisions if you don't judge your decisions by those outcomes.
Okay, so let's move on to the final piece of the podcast then, the halo effect, Damien. What have we got?
So I'm conscious I've done a lot of talking today and I'm going to keep this part short, but this is an effect that's very prevalent. And I just thought it was interesting. I want people to look out for it and see if they are falling foul of it, and then they can revert that bias that they have, that tendency. And it's called the halo effect. And in simple terms, the halo effect is our tendency for positive impressions of a person, company, maybe a brand or product in one area, and it positively influences our opinion of them in another area. So watch out for this, because brands know you think like this and they will use it. So if you think of a supermarket, you may have a positive view of a supermarket, but often they will move into other areas of finance, for example, and launch products because they're hoping they'll take the brand equity, your positive view, and use the halo effect to encourage you to take out products and services with them. And it doesn't necessarily mean that they will be the best products out there. And so keep an eye out for the halo effect. Look for examples of it and point it out to other people. But interestingly, there are 2 sides to this coin, because you can have a negative view that therefore gives you a negative view about another area in relation to, say, a company or brand or a person. I mean, I've heard this called the horns effect or the devil effect as well, so rather than halo. But do keep an eye on it, because there are people who sit there and go, I don't want to have anything to do with this brand because of an experience that they may have had in the past, but that brand might have changed. And so an example of this could be where somebody would have had a bad experience. Maybe it was with a bank, and they are now looking to take out a mortgage, but they don't want to use the brand because they assume that they had a bad experience. It might have been something that was happening in branch with their savings, and then therefore they think about it in relation to their mortgage. They don't want to deal with that company. And that is fine. That is your right to do that. And I understand that brands should try and earn your loyalty and your custom. But do be aware that that is what you're doing. You're using this devil effect. But if you're likely to do that, then you're probably likely to fall foul of the halo effect as well. And it's the halo effect that I do think personally is the one that's a little bit more troublesome, because marketing people can use that to encourage you to go and buy products and services that perhaps aren't the best in the market, and so persuade you not to shop around. So that is it then for this week, Andy. We've covered a hell of a lot. I think I've done enough this week that people's heads will be ringing for 2 weeks by the time we come back after we've had a mini break.
Yeah, absolutely, Damien. And if that isn't enough to inspire people to give us a 5-star review, and don't forget they can claim a Money to the Masses mug as well, then I don't know what is. So yes, we are having a break next week as well. Just a quick reminder that we'll be back a week after next Sunday with the Sunday show as usual. And of course, you can still get all of the usual Money to the Masses stuff while we are away on the podcast. So we've got the YouTube channel. There's still stuff going out on there. We've got the Money to the Masses Facebook group as well. Facebook.com/groups/Money to the Masses. And don't forget Instagram. There's a wealth of information on Instagram, and we're constantly updating. Actually, there's some really good offers coming out, especially talking about the summer holidays. So look out for that in the next few days.
And also, don't forget to sign up to the Money to the Masses newsletter. So moneytothemasters.com/newsletter that comes out every Sunday at 10 o'clock with all the big stories from around the money internet. So that will be impacting your finances. So it'll be stuff from us, but it'll be across the board mostly it'll be from the finance pages out there. So do make sure you sign up to that, and you can find our content from videos and that sort of thing. So it's all consolidated in there. And of course, it's not just me and Andy, is it, really? Money to the Masses goes beyond us. We've got a whole team here that will be doing lots of stuff while we're away. So please do keep an eye out for all of that.
And so that's it. We're done for this week, Damien. Until next time.
Until next time.
Whoa.